Losing capital is the biggest sin. There's no greater sin. You're better off actually having a flat year than losing money. The best traders I ever saw were
Welcome to Make Your Move, the podcast that values insights over immediacy. Now, this is a really special episode because there's so much confusion in markets at the moment. A lot of traders are sitting back and questioning where we're going, and particularly in a post-COVID world, getting the macro right, getting the strategy right, and getting asset allocation right is very important. And I've got the perfect guest here with me today, a friend of mine for a very long time and someone that's very experienced in markets, Michael Bogoevski. Welcome.
Thanks, Peter.
Now, you've got a new role, head of ECM Asia at Barclay Pearce Capital. Tell us a little bit about the role, what you're working on, the type of projects that you're working on, type of clients and markets that you look at, and then I'm going to ask you about your experience too.
Yeah, actually, that's a great intro. So at the moment, a lot of the work we're doing is in the sort of corporate advisory and capital raising space. The business also has a second vertical, which is sort of brokerage, pretty much is what you would normally see around stockbroking firms around Australia. And there's a third vertical, which is wealth management. The majority of the business is in the sort of micro cap, mid cap ASX space. So a lot of companies will come to us, a lot of mining, given that the business cycle we're in at the moment. They'll come to us and approach us and say, hey, look, we're looking to develop out a mine. Can you look to raise some capital, advise us on what are the best structures? And then we sort of bring the corporate and the clientele together and we intermediate. What is happening quite a bit, and I would say there was an important junction last year around April when the US government administration came in. We started seeing commodity markets really taking a turn for the positive. And as a result, we've seen gold prices lead and we've seen other base metals and the critical mineral space. And as a result of that, you're finding a lot of Australian companies coming online now because the prices allow these smaller companies, to make it profitable and come to market.
Hold that thought. We're going to dig into commodities and a lot more, particularly your experience. But first, a word from our sponsors. Quick pause before we dive into this episode, which is brought to you by Blueberry, the online trading platform built for pro traders. Whether you're diving into gold, riding momentum in indices, or fading to Dixie, precision is everything. That's why Blueberry's razor-sharp spreads and millisecond execution speeds means you're positioned when you're ready to execute. Trade CFDs in Forex, commodities, indices, and crypto, all from one intuitive platform backed by real humans. And with Blueberry's tight pricing, trading tools, and dedicated 24/7 support team, you're never alone. So when you're ready to make your move, make it with the broker that moves with you. Learn more at blueberrymarkets.com. That's blueberrymarkets.com.
This podcast contains the ideas and opinions of its author and is distributed on the understanding that Make Your Move is not rendering investment, financial, legal, accountant, or tax advice. The ideas outlined may not be suited to your financial circumstances and therefore you should get financial advice from a competent professional. The author specifically disclaims any responsibility for any liability, loss or risk, personal or otherwise, which is incurred as a consequence of the use and application of the information outlined below.
Now, Mike, welcome back. Before we went to the break, you did talk about what's happening in commodities and the micro. What I really like about you is you're a macro thinker, but you actually can go top down or bottom up, right? And that comes from your experience. Tell us a little bit about how you started the markets, the different roles that you've had, and how they've helped you form this worldview, which today will break down and will help traders understand so that they can implement into their trading.
Yeah, that's actually a really good question. I think if you look at the trajectory of my experience, I really started off as a quant analyst. So I was working within bond market, credit markets as a junior. Actually, when you first started off, the only way you could get a job in the markets was that you had to be really good at Excel. And so you doing modelling and what is sort of commonplace nowadays. There were a lot of older advisors and dealers at the time who couldn't use the product. So that was the only way you could get a job. And from there, slowly worked in options. So at the time, there were warrants. Warrants were a really big feature of the markets.
Particularly in Australia.
Yeah. And then we sort of moved within structured products. And then they had this desk called Stat Arb, or Statistical Arbitrage. And these were a lot of the banks, and I was working for this amazing place called Societe Generale. They're still around. And I met some heavyweight quant analysts there, and I didn't understand quant. And it was an important junction in the world where you had physicists and mathematicians and engineers slowly gravitating into financial markets. And what I soon realised is I thought I was pretty good at maths, but what I soon realised it was never going to be equal to these guys. So I learnt the art of sales. So where I started finding my edge was that I was able to get complex ideas and then bring them down into really simple ways and sell those ideas to clients. So I was sort of a technical salesperson, and that's what I've been doing ever since.
Now, you're understating your experience a little bit, and
Yeah.
I'm going to pull you up on it, because after that, you did go and help build a really successful business in Australia, Asia Pacific. Tell us a little bit about your journey from those early days working on a quant desk, warrants and these things, into perhaps the fintech space, particularly CFDs, Forex, with your time at CMC.
So around that time, towards the end there, and it was around 2000, this company came to market called IG Markets, and they were selling this product called CFDs. And that absolutely decimated the options markets in Australia because it was a far simpler product. But what was amazing about CFDs was that they did all the asset classes. And in a really simple fashion, you had a platform, and all of a sudden you could get into index trading, single stock trading, FX trading, and gold trading. And so when I came from this institutional space, the Societe Generale, and you look across the floor and it's full of dealers, precious metals, and you had FX and you had bond traders, this one platform did it all, and I was a retail investor.
Why is it important to have exposure to markets holistically for you? Is it because it gives you a range of options to trade, or because it gives you a better vantage point to make decisions?
Yeah, so this was the exact pivot point for me. What I soon realised is that being an economist in study, so I sort of worked my way as a bachelor and then did a master's in that field. I soon realised I actually enjoyed economics, but if you love economics, you're going to love macroeconomics, and if you love macroeconomics, you're going to love macro investing. And macro investing is agnostic. You're moving between asset classes, and so you have a central thesis: interest rates going up or down, economy good or bad, precious metals better than technology, right? And so you take these central theses every year or every quarter, and then you're finding ways to express it, right? So you can express it through several ways. You can sort of have an FX position, index position. You can show it in commodities, because all these markets are correlated to these thematics, yeah? And so to me, that was exciting. I could have one platform, and you could use CFDs, ETFs nowadays, and stocks, take a macro idea and then pull it into several trades or investments, over the short to medium and long term. So for me, that was a challenge, and ever since then, and that was nearly 25 years ago now, I've been investing the same way.
And your time at CMC helping the institutions that were coming to you for liquidity, growing their businesses, what did you learn as an investor individually about how institutional investing works, getting the macro right, thinking holistically, and how did that help you implement in your own trading strategy?
Yeah, so a lot of my experience really came from dealing with high net worth individuals, family offices and institutions. And they each sort of have their own idea on the way they trade. But what I saw was a whole gamut of styles of trades. You sort of had very successful traders all the way through to highly speculative traders who weren't as successful. So I learned a lot about the art of sales and education, and actually trying to get people to actually learn how to slow down, how to use leverage, right? How to come up with an idea and then say, okay, I'm going to express it in these markets. And then when you have an idea, how do you get into the trade, right? So
what do they do differently? What do the institutions do differently to say you're very good pro individual?
they understand risk. And they actually, for them, it's actually about risk control and not losing money is paramount. And I know you hear about this, but losing capital is the biggest sin. There's no greater sin. You're better off actually having a flat year than losing money. And this is the problem of even sophisticated traders who lose their way at times. They get too aggressive and they don't rebound. We can talk about behavioural, trading all day long. For me, I saw a lot of bad traders and I saw some great traders. The best traders I ever saw were people who had capital ready to deploy, first and foremost. They had a plan and they had a watch list. They always have a watch list. And this is something that I've learned. There's never a time where I don't have a watch list ready. And even though I may have invested through the whole watch list, I'm developing the next one. Assessing new thematics, ways to trade, products to use. And I think leverage is the biggest factor. So risk and how to get into a trade and slowly build, and this is where the answer your question about institutions, they build positions.
We'll get into markets, trading psychology, a lot of the how to implement next. But before we get to that, you've used a term previously called fractured world.
Yeah.
When we talk together, you and I, we speak a lot about markets and about macro. And it seems like from your vantage point, having been in markets for quite a while now, correct me if I'm wrong, but there's a post-COVID world market reality and there's a pre-COVID reality, right?
Oh,
and it feels like, tell me a little bit more about this fractured world concept that you think of.
No, I'll tell you, we talk about pivotal points in your lifetime. The GFC. I'll actually take you back to that. I never want to see the GFC again.
2008, 2009.
Yeah. I honestly, and we haven't seen it since. And this is what, do you want to talk about a fractured world? We definitely need to talk about the new world order that's just recently happened. There's been several, and I think there's a lot in the macro space around that. But if we link back to the GFC, that was a pivotal point where everything changed. Because it was the true liquidity event and when we say liquidity, we've seen bouts of it ever since. But if you notice the way central banks operate now, they activate liquidity at all costs to never repeat what we saw during the GFC. And being a baby of the GFC, you and I have had many, many discussions about private credit and private equity.
Yeah.
Because I never want to be stuck in a position for 5 years that I can't get out of. And so even in the business I'm in now, which is sort of working in pre-IPO, IPO, I will never even advise on an investment to a client that's no longer than 6 months out from IPO. So that's why you and I have had discussions where I came to you, I remember 12 months ago, and saying, I just don't like this private equity space. And I don't like private credit because you're stuck in these vehicles. And I think you were asking me why, and I said, because I was a baby of the GFC. I remember the day where seeing the Australian dollar fall. I've never just seen one of the most liquid markets in the world. The index market during the where Lehman's was going under, and the whole contagion that was happening, and the banking system stopping, and there were crisis meetings every weekend. This thing, there was a recession, and actually in finance we're in a depression. Jobs were being lost. Central banks were providing liquidity. It just wasn't enough because the system seized up. 2008
and 2009 to investors and traders is similar to our grandparents that lived through the Second World War. When they tell those stories, it's very, very similar, because I remember I was a young analyst. I was 4 or 5 years in advising clients, and I remember coming down to the boardroom one day, just sitting watching one of the business channels, and I was just completely shocked. Right, it was like an unreal world for those that traded and lived through it. There's a lot of trauma, there's a lot of experience, but I want to go back to the fracture. Is the fracture that in the post-GFC world, the liquidity tap is now back on and doesn't close? Is that the fracture for you? Or is it that liquidity has just moved into shadow markets that are going to blow up?
Yeah, so there's a and if you probably need to study this, it's actually the fracturing of the Eurodollar market, which was a key financial tool for all non-US based banks. So if you think of China, you think of the, when we say euro dollar, we don't mean the European currency. Anything that's non-US dollar based, and that, whether it's in US dollars, US yen, and you're looking for funding.
Yep.
See, these are the whole banking system, that whole fractured from the euro dollar system. And so what's happening now is that you're getting moments where the liquidity pools are seizing up, and then you're getting central banks coming in and providing providing a backstop. So that was a major fracturing of the system. Confidence from banks, the unwinding of huge trading pits amongst the big banking fraternities, moving into hedge funds. The advent of private equity and private credit is all as a result of these systems breaking and moving out of the main banking system, and finding its way into lending in other ways. The other fracturing has been the geopolitical fracturing. And that's obviously been opportunity from a trading perspective, but we've just seen it in front of us now. I mean, just look at, during the Biden era, we had what was a unipolar world, America as the hegemon, and then you had a developing China. We've now broken up where Russia invades Ukraine. And it has ties with India and China. You've got the Middle East at the time. You've got Europe now hived off, and you've got the Americans basically not supporting NATO. That was a tripolar world. New administration last year, fractures again. And now the recent news, and there's very little news about this, the Saudis have exited out of OPEC. To me, that is one of the biggest fracturings we've witnessed this year, and there's nothing being discussed. And the Saudis now have strong ties with the US, and they're the new hegemon. As a result of the rise of the Chinese, the Chinese wealth elite and business elite. So we've fractured, the frequency of fracturing seems to be happening more and more, and there's going to be ramifications out of this. Eurodollar systems, the way petrodollars are moving around. Energy security is now, for me, something I'm watching closely, and this is where it links back. I meet with a lot of mining executives now in my new role. All they're talking about, they absolutely love Trump, because they're starting to unlock, which was a gridlocked system within the precious metals, critical minerals, and base metals like iron ore. And they need to get into mines. It's all about, what I'm seeing now is we've moved into a war economy pretty much from April last year, and everyone is now hoarding and going to be hoarding even more. And the energy hoarding for AI and future development, Panama, right? Panama access points, so Panama, Hormuz, So it's logistics, energy, is the new thematics that are going to be happening now from here on in.
Let's jump into market moves. Now, you touched on something really important, which was the global order. What's happening with energy, what's happening to the euro dollar, what's happening to all these big things that are impacting markets. And sometimes we see them play out, but because we're watching markets every day, because we're now consumed with this overwhelming news flow, sometimes we don't see the big picture. So I want to talk big picture. Let's talk energy, because you touched on it, and energy is really vital and crucial, because that's going to lead into technology and AI also. And I want to wrap with asking you about how to layer in all these things to manage a portfolio, right?
Sure.
But back to energy, what's your worldview on energy? How are you seeing energy markets? How do you think this plays out? What are the biggest risks? Because oil was stuck for a long time doing nothing. Yeah. And all of a sudden it's disrupting world markets again.
You know what? I use ETFs quite a bit. So we can talk a bit about structure and stuff like that. And I use ETFs quite a bit because it actually gives you that basket access, and then you start using leverage and things. We'll talk a bit about the structuring trades, but you're absolutely right. You know what got me really interested? I get really interested in thematics, and then I look for sectors that are really bombed out. Energy was actually one of the most bombed out sector actually in November. And if you look back in hindsight, it was bumping along that 55 figure, and it was obvious at the time. So I put on a trade, and there was actually some really, we can talk about how do I find knowledge. I listen to podcasts all weekend. So this is probably, and listening to a lot of books via Audible, and that's how I pick up, other, what's the cutting edge of CTAs and the way hedge funds are constructing portfolios. And they talked a lot about oil. And so that gave me the first idea of...
They were talking about it before it moved?
Yeah, well before. It was the trade. Oil was the trade amongst the institutional fraternity back in September, October. And there were a few people talking about it. And then if you looked at the chart, and this is my favourite, I love it when you hear an idea, you check the market, and it's absolutely bombed out. And you couldn't fathom, you couldn't create a story because the narrative was so negative. The narrative was, well, there's oversupply, there's excess production, but there was this support level at 55, right? And it was like, but this doesn't make any sense because the AI requirement, the coming forward requirement, the biggest requirements coming forward, and I've seen this because I've gone to seminars and I've gone to conferences, and I'm talking some of the most successful mining executives in the world. There is simply not enough critical minerals nor copper to do what we've promised, not what we're going to be producing in 20 or 30 years. I'm talking what we've promised. NVIDIA does a forward sale, and to a data room.
Just on commitments.
There is not enough now. So how do we power these data centers? Second.
Let me just pause there. I think what you're saying for the listeners and the viewers to understand and comprehend is that if the world's intelligence is going to be driven by AI, AI is going to be driven by energy, right? And the world is energy hungry and short on energy. And so a lot of the investors that you were listening to in September, October last year were bullish energy because they understood the intelligence demand coming forward, right?
Totally. That's exactly it. So, and then it was the question of how did you express it? And you can express it in a couple of ways. You can buy, I think it's the UCO. So you can buy a straight up Delta One ETF. You can buy CFDs, futures, options. I used an ETF layering it with, so I used one ETF which had no leverage. Then once the trade sort of seemed to, there was some movement. It moved from 55 to 60 and 65 pretty quickly.
I remember we were talking.
Remember?
Yeah.
Yeah, and then I layered it on with some leverage as well. So once the trade was activated and there was something going on, and as a trader and investor, when you get into something, you sense it. And we're going to talk a little bit about just what's happened literally in the last 3 or 4 weeks. And then you start, and this rolls back to your initial question about what I observed in institutions and the way they trade. They get into a trade, then the leverage comes. The leverage doesn't come first.
Wow, that's a really, really good.
So, because you might be wrong, and a lot of the time I'm too early. I'm not particularly on a successful one.
Yeah.
I'm usually very early. So you look like a donut for a long time. GFC was the same. European crisis, I was the same. COVID, I was the same. I was generally too early on the trade looking for bottoms and things like that. So, but then once the trade is going, or the investment is going into positions, and my favourite form of investment or trading is actually a 3 to 5 year hold. But that may encompass several forms of markets, right? So a thematic, and then coming in with a single, very simple ETF to start the trade, or a single stock. And then as the trade builds and it is moving your way, and then the crowd starts coming in, and then the news starts coming in. So, and then firstly, you've got to have the doubters, right? So you've got to have this idea, there's too much energy, there's too much oil supply, yet it's starting to rise. And then by sheer luck, sometimes you need a lot of luck in trading, the war happens.
I tell you, my dad actually called me in February and he said, how do I long oil? And I said, why? And he's an ex-Forex trader and he watches this, so shout out to my dad. His thesis was different. His thesis was, well, gold has moved so much. Silver is moved. Commodities are moving. Oil needs to move because of mean reversion, right? And I wanted to make this a segue into gold because before we go into AI, I want to go back to the fracture, right? We're still talking fracture, a fractured world. Gold has been symptomatic of this fracture. So too has crypto. But gold is really where central banks have been moving reserves. Tell me your thesis around gold, and then we'll lay that into what the world looks like with AI, compute, and energy.
Yeah. I got a really funny story about gold. I was a believer of gold, but I did it in the wrong way. One thing I've learned about commodities trading is you've got to have a basket of the companies, ETFs, but you have to have access to the underlying. So let me explain. I was buying baskets of junior miners and large cap miners. And if you're in the gold trade from 23, I've got to take you back actually. I had an epiphany in late 22, 23 when I was looking at my portfolio and it was very domestic driven. And I was sort of starting to invest in offshore ideas. And I never really invested in technology, right? And so this is one of those things of you have an idea, you're ahead of the crowd, you're probably too early, and then luck comes in. So I'm going to tell you 3 pieces of luck. So the first piece of luck was oil. I got in before AI.
Yep.
I got into AI because I was like one of these podcasts. It's actually Real Vision, very well known within the community. These guys have been behind crypto and understanding the macro investing, right? One of the best macro investors in terms of connecting institutions to retail. And I've been following this guy religiously.
He calls it the exponential age, right?
You got it. We're talking about the same person.
Yeah.
He started talking about tech. I'd never invested in crypto up until then, but I had a respect for it. Right?
Yeah.
This thing wasn't going away. And what is crypto really? Crypto is a byproduct of the loss of productivity of humanity, right? If you think about it, it is one of the ultimate solutions, and eventually we're going to get into robotics. Crypto and robotics are related. It's the same thing. We're trying to get away from this idea of humans using paper money to transact in a 5-day week. Yeah?
Yeah.
Now we're moving, and we're going to talk about this and where my head's at going forward, which is tokenization, crypto, payment systems. How does the circle get complete? Because one of them, we're actually raising money for a company at the moment, and on my phone, I have a Visa debit card that only has crypto on it, and I've been showing people in the street when I've been buying coffees every day with crypto. We've never seen this before. So in the next 6 months, you're going to see the circle complete, where fiat money goes to crypto and crypto goes back to fiat money because I can purchase in real life.
So is that the second luck?
No, my second luck was the AI trade.
Got ya.
Because I listened to someone, I believed in the story, and then I was finding forms of expression. So I bought ETFs and I was aggressive, right? So I started using leveraged ETFs very early on in 2023.
To get tech exposure.
Yeah.
Listed tech exposure.
Correct. And ever since then, I've just been buying every time the market dips.
Yeah.
I'm looking for something that I like. So in the recent dip, I bought Robinhood. Robinhood because I've come from a digital platform.
You know it. You've worked in it. You understand how these businesses are built.
I was in awe of Robinhood when I was at my previous business.
Yeah.
And so I'm fascinated with tokenization, people who are on the forefront of platforms, digitization, living in Asia. You could use what is Uber over there is called Grab. I was using Grab to pay for my groceries, and this is a logistics business. So what's happening going forward is that everything is morphing into one app, right? So you'll have a trading app that has a financial services component, and you can use that app to actually pay for your everyday goods. So neo-banking, people like Revolut, Coinbase, Robinhood, they're all...
super apps. They're everything apps.
And it's here.
Okay, so that's your number 2. And what's the third? What's the third luck? Was that gold related?
So the gold luck was, it started poorly and then it ended up really, really well. I got into gold because I was skeptical of governments and the fiscal problem that was happening around the world in balance sheets. And this liquidity pools that just kept on coming every time there was a problem, because they will never allow the GFC to happen again. And Mario Draghi, and we saw comments like that, whatever it takes.
Yeah.
And so there's a cost to that. So I moved into the idea of gold. And the error that I made was that I started buying undervalued gold companies.
Got ya.
And I should have done is bought the commodity in a futures format as a CFD or as an ETF, and an ETF over a basket of companies.
So where's the luck if you made the mistake?
Because it finally moved.
Oh, right.
And then in the last year, so I lost out because the companies didn't move for years whilst the underlying started moving ever so slowly until it didn't. And then it started moving last year and it caught up. And so it outperformed the actual underlying, where gold companies were all the rage last year, and that's when the money finally came. But you had to be in the trade for 3-4 years.
Yeah, I think the lesson here is that thematic investment is important. It's not for everybody. Some traders like reading charts. Some traders like, scalping, being short term.
Yeah.
But, deep thinkers like yourself like having conviction. But the thing is, if you're going to be a thematic investor, you need to have patience. You need to be able to give yourself time, be at grace, be kind to yourself. Just because the market moves against you doesn't mean you're wrong. Because sometimes we punish ourselves for getting things wrong, right? But we can be right in the medium to long term. But if you're going to be thematic, you need to do the whole system right.
Totally.
And let's now move into this big theme that you and I have been talking about, this fractured world theme, opportunity, let's call it opportunity, which is AI, compute, data centers. The intelligence of the future is going to be very different to the intelligence of the past. How are you thinking about it? And to someone watching that wants to invest around it, tell us where your thoughts are at the moment.
Oh, look, I think we've got the best example. To answer your question, you can just see what just happened in the last 30 days. The fractured world of a war, the breaking apart of of Iran and its hold over that region, the US foreign policy into the region, and so you start seeing the market come off. And suddenly the market has this amazing, and this is something I've really learned, and so if something I've learned about the market, this is where there's an arrogance amongst, you ask me some of the things I've learned in the past and I've brought forward. There's an arrogance amongst traders that they think they can control the market. And I had a lot of clients in my past who were highly successful business people, had 5 businesses, and then they suddenly came to trading and they employed the same tactics they did in their personal life to the trading life. And so most entrepreneurs have an absolute control of their world. They've got great lawyers, they have great accountants, they've got great advisors, and they come to the market and say, I'm just going to use the same tactic. And what they soon learn is that no one knows anything about anything.
Yeah.
Everything is a game of probability, right? And you're basing everything on probabilistic outcomes. A market that's bombed out 50% is not likely to go down another 10%. A market that's at all-time highs is likely to continue going up, but the likelihood of a major 20% sell-off gets better and higher and higher. Mm. So you start thinking in probabilistic terms, right? And so I learned that you never know anything about anything, and even the experts get it wrong all the time. But it's the way you get into markets. And just recently, when we saw that the market started selling off, there was no memo. The market doesn't send a memo to you saying, hey, I've changed my mind. What it does is it has this amazing ability in just getting better and better. And this is what it's right. The market gets it right most often than not.
Yeah.
And so even if you look at the way tech has recently, it's just moved 15%. And it's melting up at the moment. And there's very little commentary about it. It's last night it just on, it's moving 1 to 2% every day. When people realised that the war was going to finish quite quickly, and we've just seen news overnight of the effort by the US government, and just at the right time, as US earnings was coming on, we were probably, I think the best part was we're about a week or two out. Crypto was basing. Tech stopped selling off. The SaaS apocalypse had stopped. There was elements that the oil situation was starting to possibly see an end. That was the flag in the ground. That was the time to get into that. I'm going to put my foot in. And then the trade started changing, and then the leverage came in, and then the news kept on being negative, right?
The best traders and investors have a sense of self-awareness. Everything that you just said, they don't try to bully the market. They respect the market as a voting mechanism that's much bigger than themselves or anything that they've ever done. They understand that this is a bigger game than where they've played. And two, they don't fight it, right? They're at peace with it. You can have conviction, you can be wrong, but you have to respect the market. Fighting it or hating it or disagreeing with it is not healthy. It's important to read the messages. And the point that you touched on there is, it sounds like you've developed a maturity to read the market, right? You sit back and you see what the market is telling you, and then you marry that up with where your own personal convictions are going, and then to execute. I just want to push a little bit further on the previous point. Where is your thesis for AI, for tech? Where do you see it going over the next 12 months? Like, have you seen the past few weeks as the base, as the basement? And we're now, I like the word melting up, by the way. I'm going to start using it. Are you seeing it melting up into the next bull cycle? Or do you think they're overvalued? Like, what's Michael Bogoevski vibing around tech, AI, and the future of investing?
You mentioned the word technical analysis and macro investing, and can they go absolutely hand in hand? I don't know of a hedge fund manager or someone I respect, particularly in that world, who doesn't use charts. So sometimes technical analysis gets a poo-poo, and you talk to a fund manager who only deals with valuations and fundamentals. I'd say you're not a trader or an investor. You absolutely have to, first and foremost, before you even think that you have an idea of valuation, you need to observe the price. And when I say observe the price, I'm talking price momentum, simple charting. Take it to your child and tell them what's happening to the market. What do you see? Right? Then you take so you have a thesis, you check the chart, and then you start developing an idea of where this is going to go. So to answer your question, just observe what's happening on the NASDAQ, night by night. Speaking to technology experts at the moment, we've only just started. Where AI, for me, only started in 2023. Last week, I was buying coffee with Ethereum. I'm seeing tokenization where an Australian person can buy NVIDIA at 9 a.m. Sydney time, because there's a market maker out there, and I can settle in cash, and I can trade, and I can instantaneously put my money anywhere I want around the world instantaneously.
I tell you what else I'm seeing anecdotally. I noticed this the other day. My office is in the city, and I walk through a lot of cafes and hotel lobbies, and you have people with their laptops opened, doing work. And the amount of people that have a ChatGPT screen opened and are just now using ChatGPT and AI as, it used to be Internet Explorer, and then it became Chrome, and then it became your Gmail or your Office. ChatGPT is now the interface. AI is becoming the interface of work. And I think in 12 months' time, it becomes the interface of everything. And you're watching this, or listening to this on an interface that's probably likely to change in the next 12 to 24 months as AI starts to become the base, right? The way we consume everything.
So you're going to get these. The other thing I've been studying quite a bit is I'm absolutely bullish. And if you ask him, where's my thematics at the moment? It's a barbell.
Yep.
One is materials, so critical minerals, gold. I can talk to you all day about critical minerals.
Tell me why copper is important to the person that's bullish on AI.
You can't have a data set without it. It's as simple as that. It's what is oil is to logistics, copper is to data centers, energy security is to sovereign risk and dominance. You've got to have all three. The US government has a fund that has the specific objective to secure critical minerals, both domestically and around the world. Technology companies are not spending this much money, and this is where it's just the arrogance of some people, and particularly some journalists. You honestly think that the Mag 7 are spending all this money and it's all, they're all a bunch of fools and this one journalist has worked it out? You're telling me that this is all a false economy and it's for nothing. It's just madness. I've got property friends in Singapore because I was living there for 5 years. They've been building data centers in India and Vietnam. They've built them. They can't power them. So we've got a big problem because the demand is far greater than the supply, critical minerals. So I think that thematic is for me the everything right now.
Let's go into closing positions. Now, we've summarized 3 big topics. We've spoken about the fractured world, but then 3 sections, 3 market themes, which has been energy, which has been gold and money and crypto and, the liquidity pump in and the impact of the financial system, and the future, which is the most important thing, the exponential age, software, artificial intelligence and the thematics behind it. They all tie together, by the way. But if there's one indicator, you spoke about technical analysis, so for the traders out there, if there's one indicator that you love putting on a chart, what is it?
Oh, it's the US 10-year. Yeah. So the US 10-year, and my favorite macro indicator is the 50 and 200 index. So you actually can get it in certain platforms. So there's this index that says the number of companies, the percentage of companies above the 50-day moving average, and the percentage of companies above the 200 moving average. That to me has actually been one of the best barometers of market tops and bottoms.
So you look at the 10-year chart, you put that up, that's your guide for everything else. It's interesting, that's an instrument, but you use it as an indicator.
Totally.
Right? You don't just put an indicator on an instrument, that is the indicator for you.
Yeah, to me it is, yeah.
And then those 2 others are also indicators for you.
Yeah, so I have screens and screens of technical analysis and charts and different forms of macro indicators, inflation gauges, and that all gives me, and it's a morning ritual, right? So I'm opening up screens of stuff and it's 20 minutes every day trying to get the vibe of what the world's going on.
Some guys wake up and they cold plunge.
No,
others do runs. You're setting up your screens. How many screens we talking?
No. At work, there's always generally three large ones, but so one's work and 2 is just markets, right?
What's something that makes you cringe when you hear it in this market? Something that is taken as gospel but is absolutely false.
Just narratives. I love just seeing. What makes me cringe is something what I see on the socials. Trading's easy. You're getting this idea of crypto bros working it out. That makes me cringe. That it's just so far from the truth.
The truth when it comes to trading, and particularly when you're sizing up and pulling your socks up and starting to get bigger and bigger, how important is execution quality, counterparty risk, working with a reputable brokerage, for example. On the other side of every trade is a counterparty, and you've spent a lot of time in business, in that space. How important is counterparty risk and execution?
Yeah, so I'll talk about counterparty risk. During the GFC, the whole reason why the GFC was about counterparty risk, where no one trusted anyone else. And so the money flow stopped. So it is paramount. You need to have brokerages and advisors of any type that have a reputable brand, have a license. I've been sort of fighting that fight for many, many years with governments and regulators about allowing clients to access licensed operators.
Yeah.
So that for me is paramount. They've got to be a licensed operator. I don't care how good their products are. Second is execution quality. You want big liquidity pools. You want to know that they're using best bid and offer facilities, within their pricing mechanisms. And also what you want to see is that they make good on their, it's a technology platform. Things go wrong.
Yeah.
You want to see good behavior from the broker when things go wrong, that they make good on your trade. If I'm seeing, I'm hearing horror stories of slippage, I never want to see that, and you shouldn't have to, right? So they're the things that are top of mind for me. A spread of markets, lots of different products, good service, a reputable brand, and I want to hear traders speaking well of that company. I don't want to hear any stories about they slipped me on this price, they didn't return my call when I had a complaint. That just
In Australia,
grates me.
In Australia, we call it the pub test.
Yeah.
Right. It's not necessarily what the pub says, but what the street says about you.
Totally.
Consensus is very important, and consensus is usually a good guide as to reputation in business. We're going to wrap. Last question before we go into the final segment, where we're going to read a question that's come from you. Make sure you keep your questions coming. We love them. Very important. This is an open engagement platform. But for someone that's watching and wants to explore this fractured world concept a little bit more, wants to kind of like start thinking about it as part of their investing in their trading, what's your final remarks, 3 key words, or if someone wants to go down that rabbit hole, how are you thinking about it, and what are the most important elements that a trader should be looking for in building this fractured world concept?
Yeah, so I think for me, the biggest advancements I had in my trading investment happened when, although I've had formal study in university and things like that, a lot of my advancement happened through self-study. So being ruthless with new knowledge and listening to ideas, seeking it out from very, people, who have a simple idea of the way investments happen, all the way to very complex ideas coming from hedge funds and quant funds and CTAs, and listening to those types. So that's paramount. The knowledge requirement and the thirst for knowledge goes forever until the very end. So for me, that's paramount, and that's really helped a lot with my, how I go about and think about things and how I actually trade and execute. And the other thing is the self-work. I think the most important thing is really, you talked a bit more about maturity. Maturity happens with understanding that you're going to be wrong a lot of the time. What do you do when you're wrong? When there is volatility in the market, knowing when to pull back. It's okay to be wrong, flatten your book, start again is paramount. Seeing when risk goes up and you're on the wrong side of a trade, close the trade if it doesn't feel right. Step back, reassess, go again. That in the last 10 years of my sort of 25-year journey has been probably the accelerator. There'll always be a trade. There'll always be profitable trades. Your trick is not to lose your capital. Themes will always come and go, and it's okay to be wrong, right? You don't have to be right all the time. And I think the other thing too is just, a lot of self-work, whatever it takes, meditation, sport, competitive sports, going for long walks, having a panel of investor friends, you and
it's
I.
a business, right?
You need your own investment committee, right?
Yeah.
To talk to all the time about ideas, how you're seeing things. Often I'll speak to a client who has a small business. What are your clients talking to you about?
Yeah.
Right? What's happening in business?
And the best ones are friends and colleagues that tell you that you're wrong, right? You don't want an echo chamber because it's pointless. You don't want to be sitting around people that are just listening to you or agreeing with you. You want people that are saying to you, Peter, Michael, your thesis is wrong for these reasons, because that goes into self-work, that goes into the knowledge, that goes into, growing up and maturing. It's a great segue because our listeners have sent through a question, and actually Lisa has sent through a question, which funnily enough touches on something that you mentioned. She says, I've noticed my setups behave differently in volatile markets. What adjustments do you make without overhauling your system? Our setups, our indicators can all be thrown out the door when those big gyrations that you and I have been speaking about, particularly during the global financial crisis, where everything was economics that we learned at school was thrown out the door, right? You had to learn indicators. But how do you adjust? How do you know when it's time to adjust what's on your screen or to ignore the noise? What's the indicators that help you shift or stay?
So just even from a pricing perspective, if you look at my technical analysis setup, it's really simple. I use trend lines. I use Fibonacci. Trend lines, Fibonacci is I still use, that's all I really use. It's the most simplistic. I'll use volume profiling. I'll use a lot of indicators, macro indicators like I talked to you before about. I'm looking at, I'll find ETFs. There's like an inflation ETF, right? It's called the RINF. That'll give me a good gauge of what's happening. I'll look at futures price. That all comes together to give me an idea. But when volatility goes up, this is a really interesting question, because when volatility goes up, the first year trader increases their exposure. When volatility goes up, if you're what you should be doing is contracting your exposure. So the way I think about it is every exposure should be risk adjusted to volatility. So if you have a doubling of volatility, you should think about just simply dropping exposure by twice as amount. I really think of the world in daily volatility. So if the VIX is at, so I have a volatility screen. I have these setups, and there's a whole different array of things that give me an idea of volatility. Volatility curves, future curves, and things like that. But I think of it in daily volatility. So if the volatility is 16, the daily volatility is plus or 2%. So if I have an exposure, I can quickly work out how much am I going to lose today based on this position, and do I want to be in this position? So you've got to push against your natural instincts to be aggressive, and you need to think as an institutional trader would, which would be potentially cutting your position, flattening your book, or if you are in the money, perhaps this is the time to increase your positioning if you're in the right side of the trade. But you cannot sit there flat-footed and do nothing. That is definitely.
So have multiple indicators across a range of different metrics.
Across different asset classes.
Yeah, you don't want one. And you also want to then reassess risk, whether you're in the red or black, and adjust accordingly, basically.
Totally.
Mate, awesome. I wish we had more time, because I literally could have spent an hour talking about your background and your experience, but you've been very gracious with your time. Thank you so much for sharing your insights, your convictions. We have to get you back because you're a wealth of knowledge, and our viewers and our listeners are a lot wiser having listened to this than without. So thanks so much, Michael, for being with us.
Thanks, Pat.
And thank you to our viewers for watching with us and staying for another episode. We rely on you, and so we're going to ask you a favor. Like always, like and share this with someone that you think can benefit from it, because that's why we're here. We're here to pass on the experiences, the insights, the convictions, and the benefit to you. And we want you to take that and bring your questions to us. Until the next episode, I'm Peter Esho, and you've been watching Make Your Move, the podcast that values insight over immediacy.
This podcast has been powered by Blueberry, a licensed CFD broker. For listeners based in Australia, Blueberry holds AFSL 535,887. You should read the PDS, Client Agreement, and FSG. For clients based elsewhere, Blueberry holds a full-service dealer license with the Mauritius FSC.